I always love when people are like, oh, I've been in the market since 2018. I've been doing real estate. I'm like, well, then you basically haven't got any experience because anybody and
Yeah,
their
yeah,
dog made money in
yeah,
2018,
yeah.
2019, and even through 2022, right?
Yep,
But it's a different game today. And so this is where you really
very
see the
much so.
real players come, stand out.
Hi, I'm Tim Bratz, and every week I sit down with the top influential entrepreneurs in the country to discuss how to leave a true legacy in all things happiness, health, wealth, and wisdom. This is the Legacy Podcast.
Hey guys, welcome to the Legacy Podcast. I am your host, Tim Bratz. Today I have a buddy, long-term friend, Chris Miles with us. And Chris is the host of the Money Ripples podcast. He has a new book that just came out called Work Optional Blueprint. And he is kind of known in the industry as the anti-financial advisor. So in this episode, we're going to be talking a lot about personal finance. We'll be talking a lot about how to expedite retirement. He retired twice by the time he was 40 years old and has done a lot of really cool stuff in the real estate, in finance, and in entrepreneurship. So I want to dive in all of it. Chris, how we doing, buddy?
I'm doing great, Tim. It's good to have to be on here again.
Dude, yeah, man, it's awesome. Um, we're talking a little bit offline and talking about different networks and entrepreneurship stuff that we have going on and how these paths that we take on our journey of entrepreneurship, right? Like you and I connected, I don't know, 5-6 years ago, maybe. And
Yeah.
through different mastermind groups, went in different directions, came back. You still have your podcast. I still have mine. And
Mhm.
it's just cool to see the good guys continuing to win, continuing to grow, continuing to make an impact. And the difference that's made of having a relationship based approach to success rather than a transactional based approach to success. So it's dude, it's just I guess
Definitely.
I say that because it's good to have you here, man. And I love seeing what you got going on. All right, so dude, you've been on CNN Money, Bigger Pockets, Entrepreneurs on Fire. You've had your podcast for a long time and talking consistently about the anti-financial advisor stuff. Let's start there. Why
Mhm.
would people call you the anti-financial advisor? Tell me about how you got dubbed anti-financial advisor.
Yeah, it actually started out with me. I actually started out as a traditional financial advisor, AKA salesman in a suit, right? And I was doing that for about 4 years. I drank the Kool-Aid. I believe that if you just set it and forget it, you would just save everything you can, be as cheap as possible, save it forever, and hopefully someday you have something. And my whole goal was if I can just save a couple $1 million, I can live on the interest in my 40s. I'll be set the rest of my life. Well, 4 years in, my dad reaches out to me and he says, "Well, when are you going to advise me?" Understand that my dad was like the penny pinching cheap saver, like post depression era kind of guy, right? And I mean, so this guy, I mean, obviously he taught me to hoard and save money. Well, when I sat down with him, I looked at his finances and everything. I said, "Dad, great job. You're debt free. You paid off your house in 18 years. And Dave Ramsey would be so proud of you right now. Good boy." And then of course, then he even like saved up in his 401k, got the company match. He did that for decades too. And I said, "But Dad, here's the deal. If you want to retire right now at 61 years old, you're going to have to die in about 5 or 6 years because that's when you're going to run out of money." He said, "All right, great, Mr. Sunshine. That's not what I want to hear from you. What do I do?" I said, "I don't know. You did everything right from what I teach as a financial advisor." And that bothered me because I didn't have an answer. I just told him, keep working, save more, right? Which is what every financial advisor freaking says. And and so I started, it's kind of like when the student's ready, they teach their peers. A month later, I decided to call up a friend of mine to wish him Merry Christmas, Happy New Year. This is the end of 2005. And now understand, I hired this guy to be a financial advisor, but then he quit to go to this crazy thing called real estate investing. You might have heard of it. And he's going to do more flips and things like that. And I asked him, I was like, "Well, how are things going?" He said, "Man, my life is awesome." He's like, "My dad and I have partnered on some real estate deals, and we've now doubled his income as a professor at the local university." I said, "Wait a minute, you've been doing this like 5 months. That's too good to be true. There's no way that's possible." And after we got done arguing about what's better, stocks or real estate, he finally just stops me. He says, "Well, Chris, how many of your clients are actually really, truly financially free where they don't worry about money?" I said, "Well, they all worry about money. Even the retired ones still worry that the market's going to drop or something like that." "Okay, good job, Chris. Way to help no one. How about this? how many of you guys as financial advisors are financially free, not off the commissions you're earning, but actually doing these investments? I said, well, I don't know. There's guys been working here since the 1970s. So maybe none of them. There's your problem. And so he kind of got me down this path. I took like the Matrix red pill. I started looking at alternative investments like real estate investing instead, realizing that it wasn't about accumulating all this money like everybody teaches you in financial advising is just accumulate, hoard all your nuts until that winter of retirement, and hopefully you don't live too long and or the winter's too long of your life, right? And so I realized it wasn't about that. It was about what Kiyosaki talks about. It's about cash flow, passive income. How do you have that money coming in each and every month? And so eventually I got to this point where I said, I can't keep teaching this stuff anymore and feel honest, right? I feel like I'm in integrity. So I quit. I left financial advising, vowed never to go back or teach about money ever again. I would just be a mortgage broker because in 2006, anybody could be a mortgage broker. And then of course I'd even do things like stock trading and teaching ballroom dancing on the side as well. I was doing all kinds of stuff. But I was learning about real estate. And eventually, as I started to learn more about it, I learned I can even like do hard money lending to these real estate investors and make money that way. The next thing I know, later that same year, when I'm 28 years old, I have enough passive income to retire. I'm work optional, as we call it, right? I work because I want to, not because I have to anymore. And that blew my mind. That was even that possible. Because remember, I was trying to hope to save and slave away till my 40s. And here I am in my late 20s doing it. And so that's why in 2007 came out of retirement, teach people how I did what I did, and with some other partners that did the same thing. The recession hit, we all went broke, almost went bankrupt. I went over $1 million in debt, had to dig out of that debt hole, and eventually had to do it again. Paid off the debt and rebuilt my passive income to the point where by the end of 2016, I was able to do it the second time. So when people say, "Man, you did it twice. That's awesome." Not really. I screwed up the first time, right? It'd be better if I just did it right the first time and kept it, but. The great thing is I was able to prove it twice, that it wasn't just a market fluke that got me there, that I had to do it a second time as well.
What do you think, speaking on that,
Yeah.
there's a lot of conversation about, oh, there's going to be another recession and the yield curves and this and that and all this conversation from economists and people who are looking at charts and sometimes accurately reporting the data, sometimes inaccurately reporting data. What are your thoughts about the recession that happened in 2008 versus where we are today? I'd love to understand your perspective on that because you lived through it, right? A lot of people have
Yeah,
not.
exactly. I got my butt kicked through it, right? It's different for sure. I mean, we definitely did see kind of a bubble in real estate. And I don't think it's very possible we can see real estate flattening at best, maybe even, lowering. I know a lot of people are like, oh, we're going to lower interest rates. I've been saying this for a couple of years. I'm like, guys, don't count on it. Like nothing in the treasury yield says that we should be lowering interest rates right now at all. The only thing would lower them is if we did move into a deep recession, which of course would affect home prices as well a little bit. But I don't think it'll be as deep because we had way massively overbuilding going on in 2006, well, really the early 2000s into the mid 2000s. They were just building like crazy. The problem is that there was nobody to buy them at that point, right? It was just build, 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 build. Everybody was greedy. And that's not happening right now. We're seeing builders trying to build, but there's kind of an underservice of new homes, especially considering the population growth we're still seeing in the US. So I think that's the thing that's keeping it not from tanking as much, right? There's definitely not as much supply. I think we will see prices in real estate challenged because I really believe you're going to see more and more people try to offload. It's already right now. I think it is a buyer's market. If you know how to buy right, this is an amazing time to buy right now.
I agree.
But the one thing I don't want people to think is like, I told this to some of our VIP clients yesterday on our monthly call. I said, listen, if you're going to be lending money to a real estate investor, like a flipper or somebody like that, don't trust the ARV. You better make sure you get plenty of equity in that because I guarantee they're probably not going to sell it for as high as they think they will. So go for like much more conservative numbers and lend on that. And I think that's going to be the case. I think there's still money to be made, especially in the flipping and yes, of course, wholesaling and things like that too. But you've got to be very, very selective. You can't just think it's like the market was, 4 or 5+ years ago. It's definitely harder now.
Yeah, dude, I agree with you. I think people assume recession means real estate because real
Yeah.
estate caused the last recession, right? There
Right.
was way oversupply, not enough demand, loose
Mhm.
banking regulations, and that was the catalyst of the last recession. So now it's synonymous with recession. It must be real estate's going to be collapsing. It's very different though, right? Lending has not
Right.
loosened up the same way it was 17 years ago.
That's right.
The other thing is the supply and demand piece, right? Like,
Mhm.
yeah, obviously there's too much supply, not enough demand, prices come down. Today is completely opposite. It's flip-flop. There's too much demand, not enough supply. And I realize there's been, some flatness on, let's talk about single family first, but like there's been
Mhm.
flatness on some of those home values and things. Well, obviously things jumped up pretty considerably, but there's also been a lot of supply still hitting the market from a lot of developers and builders who took projects on 3 years ago and now are delivering inventory.
Correct.
That
Exactly.
all ends this year though, right? Like
Yeah.
end of 22, beginning of 20, builders are all pencils down. They're not taking on new projects. They're not banking land. They're not getting new debt. They're not putting permits in place. They're not doing those things for the past 3 years because they're the most affected by these interest rate changes, right? Because they're
That's right.
borrowing money based on short-term rates. And they were the most impacted by this big hike. So they've been pencils down, trying to wait for things to kind of stabilize. And because of that, there's zero inventory. It's less than 10% of deliverables are happening in 26, 27, and 28 than what has been delivered over the past 3 years. So,
Exactly.
dude, and we're already at a deficit of all housing, especially affordable housing.
Mhm.
So, to your point, kind of what I'm seeing is I think the affordable stuff is going to continue to maintain and maybe even increase in value. The stuff under 300 grand, I think it's all going to be worth 300 grand. If you're in a decent area, I think it's going to be hard to find a house under $300,000 in the next 2 years. And,
Yeah.
but I do think there's a lot of people in high end stuff that bought high end or baby boomers that had big homes. The kids are out of the house. They're getting older. They're moving, downsizing, moving into retirement homes.
Exactly.
I think a lot of those are going to take a bath. And I think people are looking at it from a macro perspective, but there's micro markets in even
Mhm.
the single family of the area, the size of the home, the price point, and all that kind of stuff that needs to be looked at instead of just on a macro level.
Totally
From a
agree.
commercial real estate standpoint, rents went back for the first time, have actually decreased last quarter for the first time in 15 years or something. And the reason though is because of all the supply. Again, it goes back to all
Yeah.
the supply that's still hitting the market. But similarly, what I think we're going to see in multifamily is I think any multifamily that is new construction, luxury that people built, because everything that's been built has been luxury. So everything coming out of the market's going to be luxury. They're not able to rent it to luxury renters because there's too much supply in that world. So you see all these concessions, all these discounts in the luxury product. I think those rents are going to come down. But I do think, like, dude, the affordable world, just you can't build an apartment and rent it for
Yeah.
less than $1,000, right? Like you can't
Right.
do it. It doesn't economically math out. And so I do think this older vintage of apartments that you can buy for under $100,000 a door, I do think those rents are going to grow. And I think those rents are going to then dictate a higher price per door. So I do think between now and the end of the decade, that multifamily, especially like the value add side of things, 70s, 80s vintage type stuff, affordable workforce type housing, I think that's going to crush, man. So
Yeah.
it's
I
interesting
agree.
to see, right? Because even though we might have a financial economic pivot, I don't see it affecting real estate as much, right? I see it more affecting
Yeah.
businesses and stuff like that, more so than real estate. But people just generalize and say it's real estate because it's a recession. I just don't see it happening. Not for the entry
Yeah.
level and workforce type stuff, anyways.
Exactly. I mean, that's the thing is like the previous other six recessions, real estate either flatlined or grew during those same
Mm-hmm.
recessionary periods, right? So we had the one, and yeah, it was a big one. It was the biggest one of our generation. I actually believe we might see something similar, if not bigger, even if it's in a different way coming up, because it's kind of like the bigger the
In
party.
real estate or in stock market or in crypto or in like in what?
It's going to be a little bit of everything, less affected in real estate, because we kind of had the everything bubble, right? Because they printed so
I
much
agree.
money, they made it so readily available, and they did it for so long with these low interest rates and everything else. It drove everything up. I especially think the stock market will see the biggest corrections. I mean, that market is just ridiculous. Remember, I used to be a stock trader, and even stock traders that I know are like, I don't want to touch this market. This makes no sense because over 90% of trades are happening with these algorithmic traders. These really computers are making literally thousands of trades per second, right? Humans can't even compete with that anymore. And it's all based on like little trigger words and things like that pull up in the headlines. It's literally like AI just trying to make trades. And it's completely out of control, in my opinion, like completely speculative. There's a lot of debt in the market right now. That's the other thing too, right? It's almost always the bank's fault. Whenever you have a recession, like even when we saw this with not just with the last recession, where yeah, it was real estate based because even back then I could get a stated income loan, 100% financing as long as I had good credit score, right? That was before in the last recession. You know, Previous to that, Y2K, I remember that one too. That one was all propped up because tech was having this huge boom and they were predicting massive, massive growth, and then it tanked. Plus a lot of companies were lying about their numbers, right? And we're seeing the same thing. Regional banks, they're even saying, "Hey, we've had mortgage, loan fraud from businesses and commercial loans, things like that." Even in the stock market too, the values right now are comparable. Like they're actually higher than they were even after Y2K and the last recession. So we're seeing this massive, massive bubble, lots of speculation, lots of debt. And wherever there's lots of debt and speculation, that's where a crash is waiting to happen. And you're going to see a lot of people, and this is where it could affect real estate to some level in some areas. That's where you're going to see it because you're going to see a lot of people watch their retirement accounts get wiped out. They're going to notice, like, crap, I can't do this. Already, right now, people don't want to quit their jobs because literally there's not people hiring. There's literally a net job loss right now. It's been happening for the last few months that they're finally admitting to because they have to correct the numbers. And then when they correct the numbers, they find out that we've actually lost jobs, not gained jobs, right? So, all this stuff has been happening. Oh, and this is the other thing. Even credit card balances, they finally went down 0.1%, in the last month they reported. But home equity lines of credit went up. And I asked my clients, I said, hey, why do you think that is? They're like, oh, it's from doing cash out refinances. I'm like, you got it. Like, it wasn't because people are doing better financially. It's because they literally went to their homes, cashed out the equity. But at what point is it going to come due, right? At what point is it going to happen? Just like the US government, when are they going to stop spending? All this stuff has been happening like crazy. The feds are still printing money to try to keep the banks liquid, I think, to try to save their own butts. Because really, the Federal Reserve are just a bunch of bankers, right? They care about the bank. And I think that's what we're going to see happen, which means there's going to be lots of opportunity too, because I'd like to go where things aren't good. So just like I told my clients yesterday, you mentioned multifamily. I think multifamily, because it's been kicked in the teeth so hard the last 3 years, is a place to start looking into the future. Single family homes can be good too, but I really think that multifamily is a place that everybody's scared of. And that's where there's opportunity, right? That's where you want to run to. Even Warren Buffett, by the way, he's got 340 billion plus sitting in cash right now that he doesn't want to spend because he's afraid of the stock market too, right? So, that's the thing. Like right now, things are ridiculous. It's been way too frothy for too long. People are too complacent. And as a result, that's why so many average Americans are going to lose a lot of money in the next few years.
Mm-hmm. This episode of the Legacy Podcast is brought to you by Legacy Family Mastermind. I know what you're going through. I know you feel stuck in small deals, trying to figure out how do you get to that next level. I know it's hard to raise private money for real estate deals the way that the economy's been over the past few years. There are probably properties in your portfolio right now that are either losing money or at best break even, and you're trying to figure out how to turn them into winners. Or you're thinking to yourself, dude, I just want to be able to go on vacation without my business all being on my shoulders. Not having the time freedom or the financial freedom that you thought real estate was going to give you, I see it over and over and over again. But I've got the solution to every single one of those. Legacy Family Mastermind. This is a group of high-level commercial real estate investors that can help you break through every single one of those bottlenecks and help you get to that next level. You know the saying that when the student is ready, the teacher appears. Here we are. If you are serious about scaling your rental portfolio, we are here for you. This is the group to do it with. We would love to help you on that journey,
and design the exact life that you want to design so that way you can live it to the fullest. The next step is simple. Just schedule a call with my team at the link below and we'll see if it's a fit, because I want to see you sitting at the table with our legacy family. Let's go build some wealth together. I agree, like there's all these bubbles, and although I think real estate is probably one of the safest, if not the safest place to go and stack your cash and invest your money, it's going to be affected too, right? It's going to be affected because people lose their jobs. It's going to be affected because people get scared. They have to sell their house and try to pull out some equity or some cash. Maybe they move into a rental side of things. So I do think on the single family side, it might be a little bit, I think the multifamily, man, is where it's going to be. And again, we've gotten smashed in the teeth over the past 3 years.
Yeah.
But because of that, there's a lot of good deals. Like, dude, I know good deals that people are selling at the loan amount just because they're jaded. They're tired investors. They're tired operators. And they're like, they're getting screamed at by their investors. They don't want to have to deal with those conversations. They just like, let me just give everybody their money back, or, a part of their money back or whatever. And they just don't want to deal with it anymore. And they're tired of it. And they're trying to remove things from their plate, but they're good properties, right? In good areas that could perform great if there was some fresh perspective and fresh energy brought to those projects. And I think about that from a standpoint of, there's incredible opportunity on that front. If you're willing to step into a deal and say, hey, let me bring new capital to the project, you can prioritize it in the capital stack and make sure that you're protected by going into some of these deals, leave their investors in place. Maybe you figure out some sort of dilution. Maybe you get some equity. Maybe you take some equity from the operator who's moving out of the way and take over their loan, assume the debt on it, and just bring a fresh tranche of capital and bring a fresh perspective and fresh operations to it and give it more 3 to 5 year runway. Dude, I think you can get in some really, really good deals. I'm seeing them all over the place that people want to like loop me in on and all this stuff. And so, the other thing, I'm seeing a lot of people starting to look at development, land plays, new build plays, which I hate new build because it's so speculative and it's like a 36-month runway. And every time I've ever built anything, it's always gone over budget and over timelines. And you don't know where the market's going to be in 3 to 5 years on that stuff, especially if you're building to sell versus building to rent. Maybe that's a little bit safer. I think it's a lot safer, but even though I'd rather just step into cash flow from day one and put operational efficiencies in place.
That's exactly what I was going to say too, is even on the multifamily side, right? Like you want to make sure that cash flow is there from day one, so then if you do value add, it's just gravy, that's just those multiple exit strategies and pivots you might have to do depending on the market is awesome. So I agree with you on that one. And single family, that's the same thing. It's hard to find single family that you can be profitable from day one. You have to really be buy the right price and be in the right markets to do it. It's possible, but again, you can't just be like someone who just, 5 years ago, I always love when people are like, oh, I've been in the market since 2018. I've been doing real estate. I'm like, well, then you basically haven't got any experience, because anybody and their dog made money in 2018, 2019, and even through 2022. Right.
Yep.
But it's a different game today. And so this is where you really see the real
so.
players come, stand out.
Yep. Very much so. When you take a look at the traditional financial advisory world, what are some of the smoke and mirrors and misconceptions that are not exposed in that world, right? That I think about people who have money there and they're maybe timid in getting into alternative investments, and they're looking at, the stock market keeps on going up, right? And if it keeps on going up, I'm always worried that I'm going to lose out on opportunity to leave my money in the stock market and pull it out. What would you say to people like that? How would you advise them to really have a more open perspective on, hey, take your chips off the table, throw it in over here and something predictable. All right, so maybe it does go up another 3 to 5 or 8%, right? But then it drops by 40%. Right. At least you took your chips off the table. Like, is that the perspective you take, or like, what would it look like in the conversation if you were going to raise money from someone who refuted that?
Yeah, absolutely. That's like a lot of our audience too, because there's a lot of people that are they've been stuck in the set it and forget it mindset, which is such a alluring mindset because you're like, I can just throw my money there, don't have to look at it. It's just going to grow, which is exactly what a financial advisor wants you to do.
Mhm.
Because the problem is this, no matter what your balance is, and if the balance goes down, they'll say, well, it's okay. You're in it for the long haul, right? Those kind of myths and lies they teach you. It's okay. You're in it for the long haul. Just got to ride out this wave. It always goes up, which, yeah, historically, at least in a 15 to 20 year period, it has always gone up, but it doesn't mean that it's going to go up when you're trying to retire, all of a sudden,
Mhm.
right? That's what happened to my dad. He was trying to retire in 2000, 2005, 2006, but he couldn't do it, especially because right when the money was starting to rebuild again, it gets right to that previous high in 2007, and then the market tanks again. He had to wait till 2015, like most people did, till 2015 to get to the height of 2000. That's 15 years of waiting around while financial advisors get paid the entire time.
Mhm.
They don't take risk. You take all the risk, right? They're always getting paid. I think that's borderline unethical, personally.
Isn't it
And
insane that there's not a fiduciary responsibility to financial advisors and
well, there
insurance
is,
agents?
right? I mean, like I still have to take a license, continuing education, all that sort of stuff. But here's the problem: is that the government, the SEC, the Securities and Exchange Commission, they define a fiduciary responsibility as what's fit for the client, right? So if the client's willing to take risk and lose money, well, then they already acknowledge they're willing to lose money, right? And that's the thing that
And
that
that's how they get around it, right? They're not
that's how they
looking
get
out for the
around it.
best interest of the client. They're looking out for how do I get the client to sign off on these disclaimers, right? And
Uh-huh.
then put them in the investment vehicles that pay me the most commission based on the boxes that they checked on this application.
Yeah. Yeah. When I was like a traditional financial advisor in the early 2000s, the new and upcoming thing was taking this risk questionnaire. Are you aggressive, moderately aggressive, moderate, conservative,
Yeah.
or whatever, right? Like you would just have them take a questionnaire, they fill it out, and you're like, cool, I've got this for record now. This is your little magic fund or balance that you should be put in right now, and it's just based on your risk tolerance. And that's just BS. I mean, because the truth is the stock market is really high risk, moderate, mediocre returns, right? That's really what it is. I mean, there's always the lies about the 12% return of the stock market, which is not the average for the last 30 years, even despite the last 16 years being averaging like 14%. But the average for the last 30 is closer to about 8.5%,
Mm-hmm.
right? Not 10, not 12, 8.5. That's the S&P. And the S&P, by the way, that people think, oh, it's diversified. I'm safe. No, it's not. Because do you realize that the top 10 companies of the 500 make up 40% of that index,
Yeah.
right? Because it's a weighted index based on the size of the companies. So those
Yep.
Mag 7, the big tech companies and everything else, the ones that have the AI bubble that's about to burst in them, are a lot of those same companies that you're in. You're not diversified anymore in those things. So when they say just invest in the SP and let it go, and I see real estate investors doing this too, and it pisses me off. It's like you should know better, but they're like, no, no, it's okay because I take my profits, put in the SP 500. That's where it can grow. That's the worst place you can put it. That's the dumbest place. Just because the last 16 years have been almost straight up, other than a little blip in 2022 that no one remembers, right? It went down 20% and then popped right back up again. It's been 16 years straight up. Go look at the history of the market. You won't see a period of time like we've seen the last 16 years. If that's not a bubble, I don't know what is. This is why, again, Buffett has left a lot of the market. He's sold off his Apple stock that everybody's telling you to buy right now. He's sold off Bank of America. He's sold off American Express. I mean, he's selling off a crap load of stocks right now, and nobody wants to listen. They're like, oh, he's old. He's antiquated. He doesn't know what he's doing, which is what they say before every time the bubble pops, right? And then they say he's the Oracle of Omaha after everybody loses their money. That's
Mm-hmm.
how stupid people do in repeating history over and over again. And so my thing is, why would you do that? I mean, why not do what I taught people when I used to stock trade, which is when you see a profits go up, say you see a company go up for like 5, 6 days in a row, the stock price goes up. You already know you get nervous as a trader because you're like, okay, the odds are stacked against me. This will have a hard time continuing to go up. It could, but it probably won't. And so you do one of two things. One, you like say, I put in a stop loss saying if it goes a little bit lower, I bail out right away when I see the signs of it going down. And I also might just do what's
Is
called
that something that
scaling
you
out.
physically put in place, or is that something that you mentally set the expectation in your mind? I'm
If
willing to
you
take a 3% loss. As soon as it goes, I'm selling it all.
the problem is this is if you try to do it as a mental loss, you won't do it, right? Because because people always have this FOMO, natural FOMO, right? They're like, well, it went down a little bit. Well, maybe I'll wait till it goes down some more. And then they wait and they wait and they wait until finally it hits bottom. And that's when they sell. And then they feel like idiots because they sold at the bottom, right? It's always hindsight 2020. And so no, you have to set it in place manually. If you're a trader, you can't do this really with mutual funds, right? This is not the case, which is why the second method is scaling out, which is take some of those chips off the table. Like you've made so much money over the last 15, 16 years. By the way, if you're under the age of 40, you don't even know what it's like to see a down market. You've never seen one before. You're just know this. I mean, I'm saying this as respectfully as possible. You're an idiot when it comes to the stock market if you're below the age of 40 because you just don't see. You've never seen that kind of correction that we saw because I'm Gen Xer, I'm almost 50. I saw two big corrections in the 2000s. We saw nothing in the 2010s, barely anything in the 2020s. It's just been going sky high so far, so fast. And so that's why you want to take some of those chips off the table, take some of the gains. Even if it does keep going up, who cares? We would always teach people, don't look back. Like it's fine because the fact is you still made money.
All right.
And
So
there's
so
still a
let's
big
say
risk that people can lose it.
I agree. I agree. So let's say somebody, you and I, 15 years, like we have hopefully another 15 years at least, right? Where we can absorb a hit, get back up. Obviously, we wouldn't want to do that. And by the way, I have less than 1% of my, or maybe 2% of my net worth. No, maybe I think 1% of my net worth is in the stock market. So
Yeah.
I'm a big believer of not having money in there.
Mm-hmm.
But there's people that we know, right? People we care about, family
Yeah.
members, friends, our investors, right? Of people who
Yeah.
have a bunch of cash in there. Let's assume
Mhm.
somebody doesn't have another 15 years, right? How are they, and let's say they have $1 million in their 401k. They're going to
Mhm.
pay penalties. And I guess they could just take it out because they're not working anymore. If they're living off, if they're retired, they could just
Sure.
self-direct it and then deploy it into a self-directed retirement account and then invest it in real estate, right?
Yeah.
Or they could cash it out or roll it over into a Roth component. Like you hate 401ks, you hate traditional IRAs.
Mhm.
Talk a little bit about that. Talk a little bit about what your thoughts are on Roth, and then what you would do if you were somebody with a 7-figure 401k, or if you were advising
Yeah.
someone with a 7-figure 401k.
Yeah, I've talked to several of those people just in the last week or two because there's more than there ever has been. Sadly, Fidelity just came out with their stats. Only about 2% of their people have at least $1 million
Wow.
after decades of saving. The average person is 59 years old to actually hit that number. Now, here's the problem. If you have $1 million, traditional financial advisor would say pull off 3% a year if you're in your 60s. Only 4% rule, quote unquote, as the people would call it, if you're 70 and above. They've changed the rule many times. So 3%. So you have $1 million, you live on 30,000 a year. And this is what's happening. So give you a real life example. I had a guy that came to me. He's like, I've got 1.9 million there. My wife has 600,000 in her retirement account. He's like, I just turned 59 and a half. Like, what
Both
should I
traditional
do?
401ks.
Yeah, traditional 401ks, IRAs,
Okay.
all that stuff, right? And so he had that there. And he said, yeah, I keep talking to my Vanguard advisor, which by the way, Vanguard said they only predict a 2.8 to 4.8 return in the next 10 years in the stock market for an average. So that's worse than a CD right now
Dude,
with
and that's
risk.
best case scenario. That's people who get paid for getting people to put their money into this stuff. So
Yeah.
they're putting out positive, the most sunshine and rainbows type of an outlook that they can actually find, because it's not going to friggin' be that.
And they're saying 2 to 4% average per year,
Yeah,
right?
that's the best case scenario they can come up with.
So it's right to be nervous right now because you should be, right? But that's also the opportunity because, like I told this guy, I said, "Well, your situation is easy." I'm like, "What do you want for passive income, right? Like, what do you need for income coming in?" Because that's what everybody really wants at the end of the day. That's why they keep building this up. They've been taught this accumulation theory because
Mm-hmm.
financial companies get paid off their fees based on the money you keep under their management, right? So of course they want you to keep it there. That's why they tell you to live on less than the interest, anyways. Well, I told him, it's like, okay, well, the reason that your Vanguard guy won't even give you an answer about how much to keep saving and for how long is because what he's afraid to tell you is this. If you live on 3% a year, that means you got to have about triple the money. You got to have about $7 million to live on 200 grand a year of income that you desire. So he's afraid to even tell you you have to triple your money. And he doesn't really have the faith that the market's going to triple your money by itself. You have to keep working and saving. And the guy's like, I don't want to work and save till I'm 70 years old. I was like, you shouldn't. No, that's not the case. I'm like, but here, let's do the math. Let's just say you have this 1.9 million. We won't even talk about your wife's 600 grand. Your 1.9 million, say that you go and you do some lending opportunities in real estate, or you go do this or that. Typically, our typical deal that we're connected to, minimum pays them about 10% a year, right? And so I'm like, that 10% on 1.9 million is 190,000 a year. Not, not living on less than 60,000 like you would be doing if you did the traditional way, which that was why the guy says keep working. You'd be 190,000. You'd pretty much be there. You could probably even retire your wife. Now, to get to your other point, like, what about Roth IRAs? Well, Roth conversions could be good. Sometimes it makes sense, sometimes it doesn't. And there's definitely ways to strategize and make that work. Or do we just cash out? Because if I can cash out my money, get it away from the Roth, and or not even go into a Roth anyways, I'm going to pay the taxes, but then put in something that's tax advantage, like real estate that I can get depreciation on. Well, maybe I don't need to use the Roth, right? Maybe I don't have to worry about the conversion, then wait 5 years before I can finally touch that money. No, I could probably get that money paying me right now. And that's the difference. That's the key difference between what we teach versus what everybody else says. They're always future planning, and the future always keeps getting pushed back for the long haul. We're about, what about present day? How can we actually create income from that money right now? And the crazy thing, he's just like, you sound so routine when you talk about this stuff. Like, it sounds like so easy. I'm like, because it is. We've done it hundreds and hundreds of times, not just for myself, but for hundreds of other clients. Like, they're doing it. Like, there's literally people that are literally at what we call work optional, where they have enough passive income, they don't even have to work anymore. Like, it's not hard to do, but it's hard up here because you've been taught to not touch your money, not think about it,
Decades,
not do anything.
right? Yeah. Pouring these ideas in for decades, and you drink the juice long enough, man, it's hard to change the ideology around it.
Yeah.
And like, I think that the smack in the face, not smack in the face, the take the red pill kind of thing is going from 3% to 10% is not 7% more. It is 333% more of a return.
That's right.
333% more of a return on your money than it is just 7% more. Like, you're faking yourself out, right? The reason that the traditional financial advisors tell you that is because it doesn't seem like a big deal. But the reality is, it's a very, very big deal if you don't have your money earning the highest returns that you possibly can. And dude, I think it's a big deal. So
that's why I was on Cloud 9 in 2006, because when I realized, like, wait, I can lend my money to you guys. You're going to pay me. Now, that time was a little bit too rich. They were paying like 2% or more per month on my money for hard money loans. And so when I was like, wait a minute, if I have 100 grand, I can make not 3,000 a year, right? From pulling off 3%, I can make 2,000 a month.
Yeah.
It was a complete game changer in my mind. I was like, how is that? That's crazy. I'm like, it makes logical sense, but why haven't I heard about this? And the truth is, because financial advisors are not paid to tell you to do this stuff. Because if you did, you would never use them again, right?
Yep.
That's the problem. Yep. They know they would be fired.
Dude, I agree. So if somebody's got $1 million and they come and they sit down and say, hey, Chris, advise me on what I should do with this $1 million in a 401k, what would be like your diagnosis? How would you audit? And then how would you move their money around?
Yeah, we always focus first and foremost on these two paths. Do you want income right now, or do you want growth, or maybe a little of both? Because based on that, because all the different operators that we refer to, it's all based, they all have different deals. Like, for example, a syndication might have some cash flow, but might be more growth play in the future, depending on the type of syndication. Others, if it's like lending, is all income, but maybe no growth.
Yeah.
So we look at that as like, what path do you want to take with this? And then that narrows down our options. And then from there, we can say, great, well, here's 3 to 5 different operators you should be talking to that would fit what you're trying to do. The great thing is they don't pay us. Like, you only pay us, not the operators. And so come back to us.
How do you guys act? You guys are you guys like a fiduciary? Are you guys like what is your business, your traditional business? Because obviously you have clients, they have cash, and then you refer them to great deals. How does that work?
Yeah, so we just charge them a consulting fee up front. So like a one-time fee plus a small little monthly retainer on the back end. So they pay us just like that. We're not investment advisors. We never want to cross that line where I have to get extra licensing to do that, because those licenses suck, because then it stops me from wanting to do extra real estate stuff too.
Yeah.
So
those licenses are put in place by the stock market and by Wall Street to then be able to drive more money to the stock market and to Wall Street, right? Like, it's a flawed system that tries to just kind of keep things in their own box over there and eliminate any sort of outsiders. And they say that anybody doing anything else must not be doing it the right way, or must not be like,
Yeah.
dude, and it's not the case whatsoever. It's just they put it in place to feed their own ecosystem.
Yeah, yeah, it's true. I mean, Tim, you probably have had financial advisors occasionally talk to you. And if you say, hey, I've got a deal you can invest in, they're all excited, but then they have to clear it through the compliance department and they say, sorry, we won't allow that,
Yep.
because that license that you get as a financial advisor does not make you a financial genius. It just literally gives you a license to sell certain types of things. So
Yeah.
if you get a securities license, you're licensed to sell stocks, bonds, mutual funds, things like that. Annuities, if you have a life insurance license or something like that, like that's it. And so they're very stuck. They're captive to what they can actually do. Where when we broke free of that, because I dropped that license in 2005, when I broke free of all that, it's like, my goodness, like there's a whole world of alternative investments that I can be doing that literally family offices, people that have 100 million plus of wealth are already having people do for them. And so when we're saying, no, we can get you access to the same deals that the wealthy have. And these deals are amazing. In fact, they're even better than some of the wealthy ones get, because it's not like the typical, Blackstone type thing that you have or whatever, like where they were buying real estate for 20% over market value and, like they bought crap. It's not like that. Like we're going with private operators, people that like you, like that are literally like finding these deals and saying, hey, we've got a great private offering that's not publicly offered to the whole public. But just so you know, by the way, Wall Street's already talking about trying to offer these same kind of things in their own thing. And I'll tell
I heard
you
about
what's
it.
going to happen. It's going to create a freaking bubble if they actually approve it, right? If they try to offer all these alternative investments and stuff, it's going to create another bubble, but so it can be a lot of bad investments and it's going to create a bad thing. Just like when people did REITs, real estate investment trusts, not real estate, it's like, sure, it's got a real estate sort of tie, but it's not really real estate like what we
Yeah.
get in the private market. So
And
again,
it's still and it's
we're
still
kind of
structured
matchmaking them.
like private equity. Dude, private
Yeah.
equity and the fund structure is the fund manager makes a fee, whether the investment goes up or the investment goes down, and then they
Yep.
keep 20 or 30% of the ownership of any of the upside, right? Without
Mm-hmm.
taking any of the downside risk. And so it's like you're paying commissions and a percentage of your profits out to these fund managers, and you're hoping they have the competency to go and invest in good deals. But guess what,
Yeah.
man? Human beings will take the path of least resistance, and they're going to just go and raise money because they get paid based on fees for raising more money and deploying assets. And when they bring on too much money, they start investing in things that are not always great assets, not always great returns, just because they need to deploy the money so that way it doesn't lose it and it doesn't get parked somewhere else. And once you
Exactly.
understand the way that this fund structure works, then you just wouldn't invest in that stuff anymore. You would only invest in
No.
private operators like you're talking about.
That's right. Yeah. Cut out the middleman, cut out all the extra stuff there. And again, like you mentioned private equity, that's a great one where there's a market for private equity. But if Wall Street gets involved, that means there's going to be a lot of dumb money being thrown at companies that should not be getting money.
Mm-hmm.
And that concerns me a lot. That's where you create bubbles.
Mm-hmm.
There's already a big enough bubble in stocks. If they decide to open that up fully, we have an issue. And so that's where we try to get people to those private deals and try to connect them with that. Let them bounce ideas off of us if they think it's good or not or whatever, help them feel comfortable so they can take action and start getting that cash flow right now. So we're really strategists and connectors and helping them do that.
Dude, I love it, man. I love what you guys do. I love that you're helping people with their personal finances, giving them better direction, educating them on better options out there, helping them expedite their retirement, helping them increase their cash flow, and live the life, right, that they want to achieve. So it's awesome what you're doing. Chris, where can people connect with you guys? Where can they learn more about you? Where can they learn more about what you guys do? Obviously, Money Ripples podcast is awesome. You had me on there a few years back, so I appreciate that. It's an awesome podcast, and you got the new book out as well,
Yep.
right?
The
So
new book.
where can they find all that stuff?
Yeah, we got the work optional blueprint you can find on Amazon, right? You mentioned Money Ripples podcast, moneyripples.com. Even on there, we talk about like max ROI infinite banking that we actually do as well, which we actually have the highest returning, highest ROI infinite banking out there right now. So things like that are, you can get more information there or just follow us on social media at Money Ripples.
I love it, man. Well, some other time I want to talk about the infinite banking stuff. I think that's an interesting strategy. I've never really dove into it because I know real estate. That's my thing.
Yeah.
I have term insurance policy, and then I just focus on real estate. I get depreciation. I got these heavy equity growth and cash flow and all the other stuff. And the infinite banking thing was just another thing to add to the pile. And so I never really did it. It's something else I had, had to somewhat pay attention to. But I think having an episode on that and just diving deep into that, so that way I can get my head wrapped around it and be more comfortable about it. I'd love to do another episode on that sometime. So we'll figure that out offline. But dude, I appreciate you being here, man. A wealth of knowledge. I love your perspective on things. You've been through many markets, ups and downs, and have a good holistic approach that's unbiased on how to look at finances, how to look at money, how to look at the multiplication and retention and preservation of capital. And I got a lot of respect for your opinion on all that stuff, man. So thank you again for being here.
Yeah, absolutely. It's been a pleasure, man.
Awesome. Well, I appreciate you guys for listening in. This is the Legacy Podcast. We'll see you guys next Sunday.